This stock went from under 10 bucks to nearly 80 bucks in literally days. And it had nothing to do with earnings. I'm talking about Webull. Ticker is BULL. Now, a viewer asked me to review this stock, and I hadn't really looked at it, and I never used Webull as a trading platform either. So I'm going to do a quick video and go over how they started and how the options. Now, Webull is a trading platform, and they went public recently, back in April, but not the regular IPO way. They went public through something called a SPAC. SPAC is a special purposes acquisition company. So what Webull did was they merged with an already public shell company. And I'm going to show you the chart here when they merged, how the stock shot up to the moon and then crashed just right afterward. Here's the thing. At the beginning, very few shares were actually even made public to trade because of lockups and things like that. So you have low supply at the beginning and high demand with the hype around the company, and that's what shot it way up. But usually moves like this are not sustainable. These are called parabolic moves. Now let's check out how it would look to trade the options. Now before we jump right in, do me a favor, subscribe to the channel if this video is helpful and if you want to see more videos like this. All right, so here's the Webull chart, and here's when they went public via the SPAC combination back in April. So they literally went from under 10 bucks to $79.56 until crashing right down again, as you can see based on the chart. So let's take a look at some of the options. Now, right now, Webull is trading at $8.57, and we're gonna look at the December 26th option chain. Now, if you really want to purchase the stock, instead of buying the stock in the open market, you can sell a put. For example, you can sell an $8.50 put, and this last traded at $21. Implied volatility is pretty high at 60%, and the volume is pretty good at about 2,000 contracts in open interest. So as always, we're going to calculate our rate of return because you never want to put a trade in without doing that. You want to make sure the income is worth the risk that you're taking. So if we divide $21, which is your premium, into 850, which is the capital required to make this particular trade, if it's an $8.50 put, we're getting a rate of return of about 2.4% for 1 week's time. That means on an annualized basis, we're making about 128% on our money. Now, the reason for that is because it's very close to the money, right? $8.50 strike, and the stock is currently trading at $8.57, and the volatility is pretty high at 60%. Now, let's take a look if we went one notch lower to an $8 put. Well, we can see this is $3 bid, $6 ask, and it last traded at $6. Very, very low. Let's calculate the rate of return. Now, when we see small dollar values like this, you want to keep in mind what you're paying in commission when you sell the contract, as well as if you were to buy the contract back, because that drags on your performance. But if we're ignoring commissions, we're going to divide $6, which is our premium, into $800, which is the capital needed to make the trade. And that gives us about 0.7%. So if we annualize that out, we're making about 39% on our money. Now you might be asking, is this a good trade or is it not a good trade? That's really only something that you can determine. Me personally, when I look at a chart like this and I look at the options chain where going a bit out of the money really doesn't get any income, it doesn't look that attractive to me, but that's only my personal opinion. So what do you guys think? I hope this video was helpful. If it was, smash the like button. Make sure you subscribe to the channel. I'm putting up tons and tons of videos talking all about options, walking through different tickers, helping you create income for yourself on a regular basis. Drop a comment below and let me know your favorite ticker or a topic that you want to see me do a video on next. Thanks for watching and happy trading.